moving on to the next part of our lesson, dual impact of transactions. Dual impact and transactions. In businesses, there are many transactions happening during a year or a day. Various nature, different amounts, different dates. Likewise, there are a lot of transactions taken place in a business entity during a certain period. And these transactions are affected to the elements of accounting in different ways. The elements of accounting we learned, assets, equity, liability, those things are affected in different ways due to these transactions. Sometimes one element is affected twice, or two elements are affected at once simultaneously due to these transactions. Anyhow, when a transaction is taken place, an accounting element is affected or accounting elements are affected. Let's take an example. Now I will take our usual example, owner investing capital. Here, owner investing we'll say rupees 50,000. 50,000 rupees owner is investing for the business. Now I told you there can be impacts to the accounting elements. The two elements affected by these transactions we already know. What are those? Assets and equity. No need this even, because here we are discussing about how these transactions are affected to these elements. So when investing rupees 50,000, assets increase by 50,000. The type of asset is cash, and equity also increased by 50,000 as capital. Here assets are increasing as cash and equity increase as capital. So you can see in this particular transaction, assets and equity both are affected. Assets and equity both are affected. The impact is dual, double. There are two impacts to two certain elements. And we can take another example. We'll say we have to open a bank account on behalf of the business. We take some of the business money and we deposit in the bank in the name of the business as a savings account or a current account. We'll say opening a savings account for the business. Opening a savings account. To open the account, we take 10,000. As an example, 10,000. We take 10,000 from the business and we deposit in the bank on behalf of the business. So, assets, obvious. Assets first decrease. 10,000. What is the type of the asset? Cash. Because we take cash from the business. And what happened? Here, this is our business. This is our business. We take cash from this business and we deposit it in the bank on behalf of the business. We deposit it in the bank, but still it belongs to us. This is our money in the bank on a separate account for us. So, this amount is also belongs to us. But here, the type of asset is changed because this amount of money with the bank is not cash. Cash means cash balance inside the business. Here, this 10,000 is belong to the business, but it is in the bank. Therefore, the type of the asset is bank balance. The type of the asset is bank balance. Therefore, before we deposit this amount, we didn't have anything in the bank, zero. Because of this deposit, the balance increases. We had nothing at first, but with the deposit, the balance increased. So, increasing 10,000 bank balance. Now, in this transaction, assets is the only element that affected. You can see it very clearly. In our previous example, assets and equity both had an impact, a double impact. In this transaction, only the element assets is affected, but there are two different entries or two different impacts to the same element. In the previous one, the impacts were different in different elements. But in here, the impacts are different but under the same element. One entry is decreasing, one entry is increasing. There is a double impact, dual impact for the same element. So, this is what we call dual impact of transactions. That means when you record a transaction, either two elements are affected, that means two entries are passed for two elements, or two entries passed under the same element. This can be capital, liabilities, anything. The matter is, what matters, what highlights is two entries. You can take any transaction, you can take anything, any transaction we discussed about, or in our previous examples, in our previous calculations. In here, I took very familiar one, investing capital. But you can take any transaction and check this. Let's take cash sales. Cash sales, what happens? Cash increasing, income increasing. Two effects. Cash increasing and income increasing. Obtaining a bank loan. When you are obtaining a bank loan, what happens? Your cash balance or bank balance increases. On the other hand, liability balance also increases. Therefore, every time in every transaction, there are two impacts, two entries, two certain transactions, impacts, effects. Therefore, these two impacts, two aspects, two entries we call as dual impact of transactions. Simply, it means every transaction has two separate entries under one option is under two different elements. The other option is under the same elements. Most of the occasion when it is coming under the same element, it takes opposite entries. One entry is increasing, the other is decreasing. So, this double impact and double entries is simply known as dual impact, which is the topic of our lesson. As we discussed, there are two impacts for different elements or the same element from each transaction. So, therefore, these two impacts have to be recorded in accounting records separately. We'll say, now in the previous example we discussed investing capital. So, there we had two elements or two impacts, increasing cash and increasing capital. Therefore, this increasing cash and increasing capital both should be recorded in accounting records. It is just like a scale. I think you know what is a scale. You measure weight from the scales. This double entry system also like a scale. It has two impacts. These two impacts should be similar. We'll say cash sales. This is another common transactions in businesses. Cash sales. Say 20,000 rupees worth of cash sales. Let's see what is the dual impact of this transaction. First of all, cash sales. Sales is an income. We receive cash. We earn something. So, sales is an income. Therefore, income of the business increases. Now, I told you there are two impacts of this transaction. What will happen? We did not record one entry of this transaction. The first entry is income increasing. The other entry is assets increasing. The type of asset is cash. Cash asset is increasing. Just think, if we record not two but only one of these transactions, what will happen? Think this scale is our accounting equation. Now you can see both sides are equal. Both sides are balanced in this scale. Income increased by 20,000. Assets also increased by 20,000. Now our scale is balanced. Just think for a minute. We didn't record one entry. We'll say income. We only record asset increasing, cash increasing. We record only assets. Like this. Assets increasing by 20,000. What will happen? Now we don't record this one. Just think for a minute. What will happen if we record only this transaction? Will this scale be balanced? No. It will be like this. One side will be heavier. It will not be balanced. one side will be heavier and the other side is empty. So we can't balance it. In the double entry system or dual impact, the double entries should be balanced. The both impacts should be recorded in accounting records. Otherwise, what will happen? You won't be able to balance your transactions. You will see only one side of the transaction but not the other side. You won't be able to recognize what generated this amount of cash. What is the source of income? You won't know. How did we get this amount of cash? From where did we get this cash? For any transaction, it is similar. If you record only one side, we won't know how we get this. Oh, if it is an expense, we won't know how did we spend this money? To whom did we pay this money? What happened to this money? Therefore, in this double entry system, we have to record these dual impacts in separate relevant accounts. Now there is a new term, account. What is an account? Now, here we have two separate elements, income and assets. For these separate elements, we have to maintain separate places to record transactions. When sales income coming from days by days, think 1st of June 20,000, 10th of June 30,000. Like that, we are engaging in sales activities day by day. So we have to have a place to record these transactions with similar features, similar elements in a separate place. Assets should have a separate place to record their transactions. Income should have a separate place for their transactions. And also by recording transactions, we can't record it as we want. When we are recording a transaction, we should have some information to obtain, such as the date, what kind of the transaction happened, the kind, type of transaction, nature of the transaction, and the amount of the transaction. Like that, we should have specific information to obtain from these transactions recording. To record those transactions, we use a special format. A special format, it is a part of this double entry system. A special format, I call it special because it records only this impact. It records. It is there to record. It is there to record what? The thing I taught you just now, the dual impact of transactions. To record the dual or double impact of transactions. So, there is a special format. That format does only one task, that is recording the dual impact of transactions. What increased, what decreased, which amounts, in when, that means the date, amount, how, to whom we paid, how did we obtain that, how did we pay that, like that. Those information, to record those information, we use a special format and we call that format An account. An account. The term we use for the special format is the account. An account. So, to record these transactions, the impact of these transactions, we should have separate accounts for these elements. So, we have 5 types of accounts. Under this double entry system, the double entry system means the system of recording the dual impact of transactions. To record the dual impact of transactions, we use a special format called an account. There are 5 types of accounts to record these transactions. There are 5 types of accounts. There are 5. You know those 5 already. Number 1, asset accounts. What are assets account? The records, the accounts that record the impact happens to the assets. Those accounts are with separate names, different names. Examples I can provide. Building account. Then motor vehicle account. Motor vehicle account. Cash account, bank balance. Like that we have different types of asset accounts. And the second account, account number 2, types of accounts. Number 2, liability accounts. Liability accounts. Liability accounts also, there are different types of liability accounts such as bank loan account. Then creditors account. And so on. And the third type of account is equity account. Equity accounts. You are very familiar with the basic equity type of account. It is capital account. Capital account. And there are 2 more accounts. Number 4, income accounts. Income accounts. We can provide examples for income accounts as sales account. Then rent income account. like that. And the last type of account is expense account. Expense account, already you can guess what are the types of accounts. Salary account, salary expense account, advertising expense account, electricity expense account, telephone bill expense account. Those all are coming under expense account. Now, there are 5 types of accounts: asset accounts, liability accounts, equity accounts, income accounts, expense account. If you think further, these are very familiar with you because they are the accounting elements. Therefore, under each accounting element, there are various sub-accounts like building account under assets, motor vehicle account, land account, and furniture account, cash account, like that. Liabilities, bank loan account, creditors account, like that. Capital account and drawings account if you have drawings, and income account, sales account, rent income account, interest income account, commission income account, and expense accounts. Advertising account, salary account, then telephone bill account, general expenses, like that. So, we can summarize this: asset accounts, liability, income, expenses, equity. Asset accounts, liability accounts, equity accounts, income accounts, and finally expenses accounts. So, there are 5 types of accounts in total. So, what is this account look like? What are the things included in these accounts? Let's see. Here is the basic format of an account. You can see there's a blank here, blank account. The blank is for the name of the account. What is the name of the account? What are the transactions that this account records? For example, building account. Like that, the blank and the account is for the name of the account, for the identification of this account, to identify the title and the purpose of the account. And first, there is date, description, value, and again repeating. Date is the date which the transaction happened, the date of the transaction. Description is the description here doesn't mean that you have to record or write a little bit of descriptive transaction. In description column, we record the other entry of this transaction. Let's say this is the building account. Building account. We record purchases of buildings of this. So, there's a transaction. On 1st of January, we purchase a building for the use of the business. We purchase a building on cash cash base is 50,000 rupees. When we record this transaction, it's obvious the transaction date is 1st of January. So we write it like this, 1st of January. Description is the other entry. That means there are two entries here. Purchasing a building on cash, building increases, and simultaneously cash decreases. In the description column, we record the opposite entry of the recording entry, building. The opposite entry is cash. Therefore, we spent cash. The cash account records the cash entry. Therefore, cash account. Here this means the other entry of this transaction is in the cash account. There are two impacts. Building increases and cash decreases when purchasing the building. In the building account, we record cash account. Why? We spent cash. We purchased the building spending cash. Therefore, the other entry of this transaction is in cash account. Therefore, value we record 50,000 like this. You can see there are two sides of this account, and there is a T shape hidden in this account like this. When you go like this, this is the two sides, and this is the line separates the middle. Because of this T shape, we also call these accounts T accounts. So, if I record the other impact of this transaction, I'll use the T format like this. Now this is building account. The other impact is in cash. Therefore, we have to open a separate account for cash account. And we record it as date 1st of January. Why we spent this? To purchase the building. You can find the other entry in the building account. Therefore, I'm writing building account here. And amount 50,000. So, when we record transaction, it is like this to record in the T account. It is very similar to this. Date is separated, description is separated, amount is separated. In this account, it is very descriptive. It is very clear to understand. Date, description like that. Now, you may wonder why I record this transaction in two different places. That means two different sides. In this account, I record it in the left side. In this account, I record it in the right side. You may wonder. Let's say, in this account, you can clearly see there are two sides with the same information. That means same titles. In this side also, left side also, you can see date, description, value. And the right side also, you can see the same things. So, why do we need two things at the same account? In this T shape, the left side also same, right side also same. That is because we record these transactions according to an accepted method, which is known as the double entry system, but somewhat complex method like this. This side of the account, that means left side of the ledger account. The account left side is called as debit side. Left side is called as debit side. And right side is called as credit side. Just like we call our two hands left hand and right hand, the two sides of the account we call the left side debit side, right side credit side. In the T account also, if we draw a T account like this is debit side, this is credit side. To record transactions, we use these two sides in a systematic method. To record transactions, first of all, we have to sort out what is the type of account, what is the type of element that the transaction is affected. If the transaction affected to assets, if the transaction affected to assets, think the transaction causes the asset balance to increase. Assets increase. Assets increase. In this situation, we record this particular transaction in the debit side of this account. When assets increase, we record it in the debit side of the account. Debit. Then the opposite. What if assets decrease? Assets decrease. Asset decrease. What happens? The opposite. If we recorded increase of assets in the debit side, when assets decrease, we record it in the credit side. That is why I recorded cash account it in credit side. That means right side. I recorded building account in debit side, and when I to the T account, I recorded cash transaction in right side, the credit side. So here in this transaction we purchased the building spending 50,000. That means building value increased, assets increased. So therefore, I have to record that particular transaction in the debit side of the asset account. And if the asset balance decreases, I have to record it in the credit side of the account like this. Cash account, date 1st of January. The other entry of this transaction is in buildings account. Amount 50,000. Like this. So, the increased impact of the asset is going to building account, which I record in the debit side. The decreasing impact of the transaction goes to cash account, which I record in the credit side. So this is the theory. If assets increase, you have to record that impact in the debit side, that means left side of the account. If asset balance is decreasing, you have to record it in the credit side of the account.